Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 24th of July. I'm Daniel Lam, your host for the podcast. This week is a macro blockbuster week. Let us go through the key events and our thoughts on those, and we can then dig deeper into some of these during the upcoming podcasts. First of all, there will be the FOMC. Results will come out in the early hours in East Asian time on Thursday. Market expectations and also what we're expecting is a 25 bips rate hike. But the indication for the path following will be of utmost importance, i.e., will the Fed take into account the recent slowdown in the latest inflation and jobs data? Or will they continue to hike more in order to slow the labor market down? We believe the Fed is likely to leave the door open for further hikes, but at the same time likely to, quote-unquote, stand pat after this July FOMC meeting. Now on Friday, the BOJ decision will also be heavily watched by investors. Now we spoke about Japan in last Thursday's podcast, and on last Friday, the Japan CPI data was around expectations. Thus, it is likely that the BOJ may keep the economy running hot for now, in order to err on the side of caution. Nonetheless, the strong Japan data for the first 5 months of this year, plus the aggressive spending pattern, suggests that significant tightening could be in place in the fourth quarter this year. Finally, we have the China Politburo meeting. With the economic data falling behind expectations, will we see a large-scale stimulus from the government? Well, we believe the economy is weakening, but it does not appear to be slowing at such a rapid pace. The new Chinese policies appear to be focused upon long-term and quality growth. The government is likely to deliver targeted stimulus, however, which may include a combination of further loosening in housing policies, especially in Tier 1 cities, fiscal stimulus, and the strive to encourage consumption. Now, would a targeted instead of a broad-based stimulus lead to further pressure on Chinese assets? Well, we believe any potential pullback is likely to be limited. First of all, valuation in MSCI China is once again back to more than -1 standard deviation compared to 15-year average valuation discount versus the MSCI All Country World Index. Economists are already adjusting down the expectations in the economic data. In other words, the bar is lower and becoming easier to beat, and delivering positive economic surprise is key for asset prices to perform, as we've seen in the case of US equities year to date. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.